You're listening to the Master Passive Income Podcast Network. Welcome to the Master Passive Income Show. My name is Dustin Hiner, and I'm here to help you create wealth, afford anything you want in life by investing in real estate, and achieve financial freedom. And in today's show, we're going to be talking all about how to invest in notes, how to lend your money, how to make money, and become the bank like investors do. And we're going to show you how to do it as well. All right, let's start the show.
Welcome to the Master Passive Income Podcast, where we talk about investing in real estate with a special focus on making enough money so you can quit your job and live the dream life. And now, here is your host, Dustin Hiner.
What's up? What's up? Thank you so much for being here with me on the show. Super blessed as always to have you here. And I'm going to share some amazing things for you as a real estate investor and an investor in general. Now, more than likely, if you've been listening to me and the podcast for very long, you know that I'm a real estate investor. I have 30 plus rental properties, short-term, mid-term, long-term properties. I've just bought literally a 355-unit apartment complex, invest in hotels, as well as teach people how to invest in real estate. Now, what's interesting is as I continue to build my business, I go along the investor success roadmap. And with the roadmap, I realized that everything that I do in my investing, my own personal investing, goes along that roadmap. And if you listen, I think it was 2 or 3 episodes ago, I talked about the real estate success roadmap that you play. But the funny thing was, it wasn't until now that I actually put, pen to paper and shared with you the roadmap, mostly because even though I was playing or going down that roadmap and going down the path, I didn't really even know that this was the path I was taking. I was just doing it. And it came about that as I was going to my own personal mastermind, we did a 3-day retreat, which was super amazing. Tom Sylvester, Michael Kwan, and Adam Carroll, myself, we had such an amazing time with each other, diving deep into each other's businesses and lives because we're really, really close friends. We've been together for 5 or 6 years now. And as we were working through everything in each one of our businesses, we got to me, Master Passive Income, everything I'm doing with real estate investing. And we started mapping out the entire process of what a real estate investor has to do. Because as we were talking about everything in our businesses, we're trying to figure out how we can better serve our students, serve the people that we are helping to invest or to do whatever. Like Tom, he's an amazing business coach. He takes businesses that go from 6 figures to 7 figures or more. He's amazing at that. So he's helping us go through our businesses and we're all giving our 2 cents. Well, what it came down to was we mapped out the roadmap that all investors must go down. Now, you start at the very beginning. You're basically at the starter phase or beginner phase. And, go back and listen to the entire episode where I literally walk you through the entire roadmap process. But you start at the beginner or the starter phase. And then from there, you get into the intermediate phase, or basically you're the business owner. You're now creating and you're accelerating your business. And then you get to the investor phase where you are an expert investor. You have reached financial freedom. And the reason why I'm bringing on my guest today is because I want to expose you to these things that we as investors do. Now, I personally love the idea of becoming the bank. And if you have ever played Monopoly, you know that real estate helps you to become where you just make more and more money, and then you lend money to the bank. It's really what it comes down to, and because you have all the money. But with becoming an expert investor on the roadmap, there are different asset classes that you can invest in. And the reason why the last few, maybe months, I've been talking about the investor phase of this roadmap. Remember, there are 3 sections: the beginner, the intermediate phase, that's where you're the business owner, and then you're the expert. This is the expert phase. I want to expose you to what's out there for us. Now, when I say us, these are the people that are in the expert phase, the investor phase, because we have more money than time. That's really where it breaks down is when you're starting out, you have a lot more time than money. Trust me, I've been there. Most of us, or all of us, have been there. We start on the roadmap and we have more time than money. Then, as we're starting to make more money, then we need to create a business. That's where we become the business owner, the scaler. That's when we now have a system that makes more money for us, and then eventually we become financially independent. That is the gauge, or that's where the transition takes place, where you become the investor expert, is where you have financial freedom. Now, then you also need to expand your asset class to other assets because you have more money than time. I love investing with other investors who are terrific at what they invest in, be it mobile home parks or note investing or hotels. Like, I don't want to do any hotel. I don't want to do hospitality at all, but I'll invest in people who want to do that, and we'll both make money, which is great. So the reason why we're bringing on my guest today is to expose you, like I was saying, to what is out there. And this might strike you as like, man, I now am getting to the point where I now have more money than time. Let me make my money make money for me, if that makes sense. I'll basically park my money and have other people utilize my money so that I can make money on my money. Sorry, it's being a little convoluted. And you guys know that the Master Passive Income Podcast Network, we have other shows. We have the MPI Multifamily Investing Podcast, just got started talking about multifamily commercial real estate investing. But we also have Your Passive Income Life, the Passive Income Life podcast with Zach Zimmer. He's a coach at Master Passive Income. He invests in notes. Like, he literally lends money and lends to other people and makes so much more money. He loves lending money to people. You literally just let them worry about making you money. And then let's say you lent money on a house and the person you lent the money to can't pay you back. Well, you take the house. It's pretty amazing that the protections and how you make money and all that stuff with note investing. And that's what we're talking about today, is getting you into the expert investor phase that maybe in 5 years from now, 4 years, or even 10 years from now, you're going to put this on your radar. Put this on your radar as what you do as you're going through the Master Passive Income Podcast roadmap that you're going through, starting as a beginner, as the starter in this entire roadmap. Then you're in the business owner scaler phase, and then you get into the investor phase, and that's when we get into larger deals. That's when we now have our money work for us. Now, that's all to lead up to this amazing interview where I interview a gentleman he started in real estate, and he realized, man, I make more money lending money in note investing, and he's going to show us how he does it. He gets other people to invest in his deals as well, or his note investing as well. Super, super terrific. You're going to get so much great value out of this, but keep this in mind that you are an investor. That's the roadmap that we're taking, the real estate success roadmap, where you're going to get to the investor and you're going to start investing your money because you're going to have more money than time. All right, let me jump into today's show where I interview Chris Seminy, who is going to show us how to make our money make more money for us. All right, here we go. Chris, thank you so much for being on the show.
Dustin, thanks for having me today, and I'm happy to be here.
You and I were chatting just before we got on that you started out in real estate investing, and from residential to commercial, and you've also got into note investing, which most people don't even know what a note is. But let's start with what made you get from real estate into note investing, and almost even how'd you even start doing that?
Yeah, so I always joke with I either blame or thank my wife, depending on the mood of the day. And like most real estate investors, you target rental property or fix and flip. And, like you mentioned, I love to, just over broke for a job. You're doing that while you're trying to work and while you may have a family. And that's where we were at. We were, had 2 young kids at the time, and we were buying some rental property. We were rehabbing them and, getting ready for rentals, and we turn around and get them rented. And after doing several of those, and we were spending all weekend long at these properties because my background's in construction management. And my wife's in finance, but she also, basically can swing a hammer much better than I can. So we'd be at these properties, and then finally we realized this is just way too much. And also is really challenging to find property because you're in such a competitive market, which we are outside of Washington, D.C. So my wife is like, hey, we just can't do this anymore. I'm like, yeah, I kind of agree. So I started thinking, okay, what else can I do with real estate? Because I'm not a stock guy. I'm not a options guy. I've always been a real estate guy. Graduated college, worked for a construction manager on the commercial side of things. So always been in real estate. And then I stumbled upon note investing. And when I did, I was kind of pissed off. And the reason why was I've been in real estate for almost 20 years. And I'm like, I knew private lending existed, but I didn't know true note investing of buying loans on the secondary market, especially non-performing loans. I didn't know it existed.
And I want to pause for a quick second and share that honestly, I really want you to invest in real estate. Now, my new goal is to help 1 million people invest in real estate. So 2 things I would ask from you. Number 1, if you get anything out of this episode, please share it with somebody else. Just say, hey, check out Dustin and Master Passive Income. He really wants to help 1 million people to invest in real estate. That's number 1. Number 2, I want to get you to invest in real estate. Get my real estate investing course absolutely for free. Text the word rental, RENTAL, to 33777. Rental to 33777. I'll literally give you my course, show you how to find an area of the country to invest, how to build the business first. I always talk about that, and how to find the right properties, how to make sure you're getting experts to do the work for you, and scale the business to where you're making $250 or more in passive income. Scale it to quit your job. I'll literally get to you, or go to masterpassiveincome.com/free course. Obviously, it'll be in the description, but I really, really want you to invest in real estate, because the more that actual, normal, everyday people own real estate that are good landlords, the better everybody's life gets. You are making money passively, and then you find out that there are notes, and these notes where you can, buy up and start investing your money. Now, did you sell off all your real estate and go into the note investing, or do you still have some real estate as well?
Oh, I still have real estate. Yeah, I've never gotten out of the other real estate. I'm a big diversification guy. So while I love notes, I also, we got some rentals, which, isn't passive in my mind, owning rentals. We own some land, we own property. So yeah, we've got other aspects of real estate within our portfolio. Because again, I'm a believer in, diversification across even just not other asset classes, but even within real estate.
So what makes note investing? Well, number 1, what is note investing? Because most people don't know what that is. And number 2, why is it so attractive to invest in notes? I mean, first thing that I think of is that's how banks make the most money. They're the ones that make money. You and I, we have to work hard if we're flipping homes or getting a rental property. But man, when you become the bank, you make a lot of money. So what is it? And then why would we want to do that?
Yeah. So first, note investing is, being the lender. Like you mentioned, I always joke, if you drive through any major city, who owns the tallest building? It's probably going to say Chase, Wells Fargo, or pick a bank. Banks do have advantages over an individual investor, which we won't get into in regards to lending. But a simple example is if you buy a house and you get a mortgage with your lender, typically like within 90 days, you'll get a notice in the mail that says, going forward, please send your payments to XYZ. Most people always get those. Well, guess what happened? Your mortgage was just sold. Now, typically, it might get securitized or sold, and again, all these fancy terms. But what we do is we're that person. We're buying that loan. And so we become the bank, we become the lender. So that's what note investing is we're just buying mortgages instead of the banks buying them.
It sounds amazing that you could become the bank, which is great, but it also sounds a little complicated. I mean, is there like a Amazon for notes that you can get into? And then what happens if, like, these things are all run through my head. How do you not lose money? What if somebody goes forecloses and all that sort of stuff? But I guess we could take it from the beginning. Where do you find these notes?
Great question. There truly isn't a Amazon for note investing. It's truly relationship based. And most banks, what they will affiliate themselves with are called large whole loan traders. And what that is, if people have ever like bought a company or, merger and acquisition companies, is really what these companies are. They're facilitators, just like there's real estate brokers. They're just like a broker, and the banks don't know, hey, who do I sell these to? We're a bank. So these companies will get set up and they will know who buys and sells, and you have to apply to these companies, and they'll do background checks and credit checks on you, because you have to realize when you're buying somebody's mortgage, think of all the paperwork you filled out for that application. All of that's part of the package. Your income, your job, your pay stubs, your tax returns, your social security number, all of that's in there. So you don't just want, Tom off the street corner, getting access to all of this information. So there's traders who, deal with those. And then there's individual sellers and other funds as well. But it is a very small, tight-knit community of where you can buy loans.
When you're getting into the investing in notes, what type of return could somebody expect? Somebody gets I'll give you an example. I just bought a house. It's an Airbnb, a short-term rental property near Nashville, and I'm paying 8%. And hopefully it seems like the Federal Reserve is going to lower rates, which mortgage rates come down because of that. It's kind of correlated. But with that, I'm going to refinance. But what would you say about how much money can you make? Like, what is there a certain interest rate? Is there an IRR or internal rate of return? How does that? How do you figure out how much money you're going to make on a note?
Yeah, so there's two types of notes that typically you see, called performing and non-performing. And I think definition's pretty self-explanatory. Performing means the borrower is making their payments, and typically you're not going to make a lot of money on those because you're basically going to pay face value for what those loans are written at. So if it's an 8% loan, you might get, 8%. You can sometimes push it a little higher if there have been sketchy pay histories on those to get them up to 10 to 12% returns on those. So the interest rate almost doesn't play into account a little bit, because if the note's at 6%, you just buy it for a little less discount compared to one written at 8%. Non-performing, which is what we like to include a lot in our portfolio, is when the borrower is not paying. So think of going in and buying, I'll use the example that people can relate to. A performing loan is similar to buying a house that's fully nicely renovated. The value is probably going to be pretty close to what you think it is, and you're not going to have to spend any time or effort in repairing it. Non-performing loan is more like a house that is a rehab. You kind of have an idea what it's worth. You kind of have an idea what it may be worth at the end of the day and how much you're going to spend, but you need to keep a factor of safety because there's more risk involved. So you want a greater return on that asset. And on non-performing loans, yields can be from, 15 to 25%. In the past, pre-COVID, you could push close to 30%. Today, even though people think, oh, interest rates went up, so you should be making more. No, it's actually it's like everything else. All pricing has been compressed. And one thing I just also want to mention about note investing that's very different than real estate, that, again, we're not buying the property. We're just, giving them owning the loan, is, you can't there's really no leverage in the sense of, like, I can't say, oh, I'm going to go to Wells Fargo, I'm just using them as an example, and say, hey, I got a $100,000 note. Can you lend me 70,000 on it? They're going to be like, no. It's like, we don't, there are some banks, but it's very rare that somebody can get what's called note on note financing, which in the real estate space, leverage can have significant upside to enhance returns, but also can have, again, significant downside. So in our space, there's no leverage. So typically that, it's an unlevered return, which is traditionally lower than a levered return.
Obviously, making money is something that we want to do. Also, my mind always goes to, how do I not lose money? Like, how do I not throw my money away? And how do I get it back? If anything, I just want my money back. And if I can get interest, that's exactly what I want. So that's usually what I'm looking for. But how do we make sure we don't lose money?
Yeah. So again, one of our main focuses, for us is always the preservation of capital, with any investment. So what we will look at is when we do note investing, we focus kind of on three things. We call them the three Ps, which is the person, the property, and the predicament. And the property plays a significant role because that can have significant risk. And give you some examples why. If your lender came and knocked on your door right now, would you let them in your house? No.
Definitely not.
Yeah. So we don't get access to these properties. So we can only get evaluation based on what it appears to be from the outside. Now, we will typically, devalue it because we don't expect a borrower who hasn't paid in 2 years to have a brand new kitchen, appliances, and everything else. And then the other thing we'll try and focus on which is much easier today than previously, is equity in the property. And the reason I mention equity is, I'll just give an example. We like to buy loans that are like, say, 10 years old. So 10 years ago, if you bought a $200,000 house and, basically put $20,000 down, so you owed 180 on a $200,000 house. What do you think that house is worth today? Any idea?
Oh my goodness. Yeah. At least double.
Yeah. And your mortgage payment typically goes down. So 10 years ago, there was, it was pretty levered. But today, let's just say it's $150,000 balance on a $400,000 loan. So our loan is secured by that property. So if the borrower does not pay, we could foreclose on them. And at the foreclosure sale, we're owed 150. If it sells for 300, or, we don't get all the money, we only get what's owed. So we would get that 150,000. Now, we also would buy this loan at a discount. So if the loan was, $150,000 loan, we might pay about 110,000 for it. So that preservation of capital, when you look at kind of the numbers, is, I'm just going to use simple numbers. We bought it for 100, they owe 150, and it's worth, I'm just going to say 300. So the loan to value is 50%, but our investment to value is only a third because we bought it for 100, which is the preservation of capital, on a $300,000 property. So that's an area that we really focus on in our portfolio, is for the properties that have that equity, because certain places today, Florida, for example, people are mentioning prices are falling in Florida. If that 300,000 goes down to 200,000, we like to say we still try and we like to think we're still protected.
Yeah, you don't want to be underwater like it was back in 2008, where they owe more than your investment is more than the house is worth. You definitely don't want that. Now, you said something that kind of caught my ear. So let's say we bought it for $100,000, bought the note for $100,000. They owe 150, but they sell it for 300. If are you owed the 150? Who gets the balance, the $150,000 extra? Like, how does that work out?
Yeah. So if it did sell for 300, then it would either be other lien holders or the property owner. One thing people, when you think of a foreclosure, all it is a forced sale of your property. So let's just say you own a home right now that, you owe 400 and it's worth 500. You don't use a realtor, it's forced to sell. But when you sell any type of property, it's like, okay, let's pay off all the lien holders. And then the left, or the gravy, goes to that homeowner. So really that's, a lot of people think at foreclosure that, the bank's going to get every single penny. No, the bank just gets what they're owed. They don't, because people think, oh, you're going to get 300 on $100,000 investment. I'm a $300,000 property. And I'm like, no, I wish. The most I can collect is what they owe on the loan.
Not any interest. Like, so let's say they
owe
the
interest we would. Yeah. So there would be like accrued interest and stuff like that. But, yeah, but if it's sold for
but they can't take the equity. Yeah, you can't just take the entire house because they owe 150. It's worth 300,000. They sell it for 300,000. You get the whole thing. It's not that. I get it. Yeah. So they're trying to make what do they call it? Make good or make complete the loans and the liens so that everybody else is paid off, and then whatever's left over. Whereas back in 2008, there weren't any leftovers because everybody was underwater, and so the bank was literally eating $100,000 losses because they had to take the property, and so no longer the homeowner gets it. So that makes sense. What else am I missing? Because it seems like we have covered the bases from protecting our assets, being able to. Oh, I guess one thing I'm thinking of, and you can definitely chime in if you think of another one. But like in the foreclosure process, it's a long time, but there's also costs involved. Does that come out of the transaction? You sell the property. How does all that work out?
Yeah, so it truly depends. And this is one of the challenges with note investing. Every state is very, very different. And I'll just use an example of if I had, the same loan in Georgia as I do in New York, the New York loan is probably worth 50 to 60% less than the loan in Georgia. And the reason why is in New York, it might take you 3 to 5 years to foreclose on a borrower in New York. So, time is money when you're talking IRR and everything else. In Georgia, it's 3 to 5 months. So think of, time value of money. If it's $100,000 investment, what's it going to be worth if, 3 years from now versus 6 months from now? It's very, very different. If you're trying to target, let's just say a 20% return. So, that future value, working backwards. So that's a very challenging component is making sure, understand the state laws. And the other component to it too is, what can you add on to the loan and what is like you have to absorb. For example, in Michigan, like the lender has to eat the foreclosure costs. Like that's on you. But in other states, you can add it to the loan. And then what happens is what a lot of attorneys will do, and this is where, I'll say the federal government kind of, I'll say did a good thing. A lot of people usually don't think they do good things.
They don't do good things very often.
Yeah, what they came up with, it was called, Fannie Mae, if you haven't heard of who they are. I mean, they basically are a quasi-government agency that buys up a lot of the loans that from traditional banks. So they came out with standard foreclosure costs by state that people could charge because what, could have happened is, let's just say, XYZ lenders like, okay, I'm just going to charge $30,000 on this foreclosure. One attorney charges $3,000 and the banks go with the expensive one because maybe they want the property back or whatever the case may be. They came out with, hey, it's this much money to foreclose, or what attorneys can charge in that state on top of, the court filing fees and stuff, which are always changing. But at least they came up with a set of guidelines for like, here's how much. And then you just have to understand, like I said, each state, whether or not you can tack that onto the bill or whether or not it's something that you have to, eat, which impacts your acquisition price.
That makes sense. Now, is this something that anybody can just get into? Let's say they had, I don't know, $100,000, $200,000, or whatever dollar amount. And I know you would know the good dollar amount, but like, it doesn't sound like something that anybody could just say, I want to go invest in notes. Let me just start calling some banks and see if I can buy their notes from them. But like, can somebody get into this themselves?
You could, I'd say like any type of real estate investing strategy. For me, I spent about 6 months just learning the space and networking and getting contacts so I could actually get some loans sent to me to bid on and understand kind of like, what are the numbers and where things work. But it's, people, I always caution people because it is a, legal intensive industry and it's conflict oriented because if the borrower stops paying, it can't be like a tenant, like, oh, I just let him go 6 months, without paying. You need to take some type of action. And, certain people don't like conflict. The other is it is heavily regulated, from a licensing standpoint, from who can collect the money. We use third-party companies to collect the money. So it is something that is extremely heavily regulated. So from that aspect, it has more risk than traditional, hey, I'm going to go buy a rental and put a renter in there. We've been on 8 years. We've had, I think it's 2 occasions where we've been, I'll call it cross complaint, where we filed a foreclosure and they turned around and sued us, saying, hey, you shouldn't be able to foreclose upon us, in those instances. So just, how often as a landlord, if you own single families, you ever get a lawsuit. And in those instances, it's typically somebody may trip and fall and insurance covers it. Here, there's no insurance to cover you. You're going to have to get an attorney and defend that lawsuit.
So I know you have Seminy Investments, which
Yep.
does basically allowing people to invest with you.
Yeah.
Is there a certain dollar amount that you would say, if you have this dollar amount, then we can start investing with you? And with that amount, is there expected rate of return? Do we invest in a specific deal? Is there a fund? How does all that work out?
Yeah, so we're a fund that we went through what's called the Regulation A+ offering process, which is, a lot of past investors heard of 506B, 506C, crowdfunding. Regulation A allows for both accredited and non-accredited within the offering. And our minimum investment amount is only $5,000. So it's not, hey, I got to stroke $100,000 check without knowing who you are. It's $5,000 minimum. It's a 4-year lockup period within the fund. You are buying shares of the company. So it's not one asset. It's every asset the company owns. It's preferred shares. So on the capital stack, you're a preferred shareholder. But we also don't have any debt. So when you look at the capital stack, besides my salary or my team's salary and our regular bills, there's not if we've got $30 million, there's not a $24 million loan that's floating out there, on top of it. So we tried to keep it extremely simple for people. The returns for a $5,000 investment, we target 8% is where it starts. And at $25,000, we start giving bonus shares, and the returns can increase from that point up as well. So, that's where we are a income play. Where people looking for targeting that monthly cash flow. We're not a VC or growth play where people are expecting this big bump at the end. I like to say to people, hey, we're the lazy river at the water park. We've been on the roller coasters too many times in life. I like the lazy river now.
Well, definitely. As you get older, usually you have more money than time, especially if you're doing well, you're investing in real estate. Like I have more money than time, and I need to be able to put my money in places that are going to make me money, and that I'm not going to have to really be concerned about losing that money, especially with great companies or even just my friends. I give you an example. I invested in hotels with my friends who they're the ones taking it down. They're the ones doing everything. I think I get 7-8% return on it, but then also they're looking to sell it within 4 to 5 years, which get us, value add as well, and close out and get money back. And rather than me, because I don't have time to just all the money that we have, it's hard to constantly deploy it. Well, it's like, yeah, hey, there's a good option right here, good investment opportunity right there. And so if somebody were to invest with you, let's just use, I'm just curious, what's like the top, let's say somebody brings in $200,000, like what's the most we would probably see on a return? 8% is great. That's a great preferred return. I mean, you put $100,000 in, you're getting $8,000 a year. With that, if we were putting what's the high end that we would be able to make?
Yeah, around 11 is where it tops out. So, tops out around 11% to investors. And, you mentioned one thing too. It's interesting because I have this thought process too of I also invest in other types of deals. And for me, I run a fund, and when I invest, it's like, hey, take my money and just go do your thing. And I kind of just want to leave it there. Where I know some people well, I only want a 12-month lockup or this. I'm like, I don't want to have to find a new deal every year. And that's one of the things where for us, it's a minimum 4 years, but after a 4-year period, you can let it ride and keep it. You can take some of it out. You can, do whatever. There's not and I know some opportunities will basically be like, well, if you don't let us know by the 47th day before it expires between the hours of 11 p.m. and 11:12 p.m., it kicks in for another 5 years. We don't have any of that. It's the, after the 4-year lockup, people do have their rights. I will have to make a note. There is some gate clauses in there. So everyone all at once can't say, hey, give me my money back, because that would cause, us to mass liquidation, which could impact, the returns of the fund. But other than that, we tried again to keep it as flexible as possible for investors.
That sounds great. Now, what problems have you seen? Now, we've talked about a little bit of foreclosures and stuff, but what other problems have you seen that you've encountered that we should be watching out for when we're investing in notes?
Oh, great question. So the first thing that I think a lot of people hear the term notes, and there's funds that are note funds, and they also may issue notes. So, understanding, a note is just an IOU. That's all a note is an IOU. And whether you're investing in a note fund or you're doing a note, whatever the case may be, is what is backing that IOU? Is it real estate? Is it, cars? Is it, a business? So that's the first thing people have to understand is what exactly am I investing in and what secures that component? Okay. The other thing we like to try and talk to people about and make sure they understand are the tax consequences, because they can be different consequences depending on the offerings. Typically, a lot of notes are considered ordinary income because it's interest income. For us, we did structure it differently as a corporation where we pay corporate tax. So investors in our fund, get a 1099 dividend. I can't provide tax advice or anything, but if you Google dividend rate versus ordinary income rate, you'll see there is a significant difference from a tax perspective on that. Then the other is, which is also really, really important, is what lien position. And what do I mean by that is, and again, if you own a house, you go out and get a mortgage, then all of a sudden you're like, you know what? It's been 7 years and my house has got an extra 300,000 with it. And, I want to go pull $100,000 out of my house. Well, you're not going to go refinance that whole mortgage. You might get what's called a line of credit or a home equity line. That home equity line is considered second mortgage because it's in a second position behind that first. Now, those are much riskier investments than investing in firsts for numerous reasons of, 2008, 80-20 loans were the thing. I had one, I remember. And, you basically get 80% of the first, so 20% second. But if values come down, that second could get wiped out. If the borrower files bankruptcy, they could say, I think the house is only worth $250. It could wipe out that second mortgage. Your first mortgage, always protected. It's got a get out of jail free card. That money is either owed. The only time it's not is if they file Chapter 7. But then if they do that, they don't owe you, but you get the property. So it's kind of like, but, in that second mortgage space, it is very different. So something to understand, because the way we like to explain it the best is when you invest in first, you primarily are trying to hit singles, doubles. You may hit a triple and a home run here and there. When you're investing in seconds, you're typically either hitting a home run or striking out. I was talking to a guy the other day. He bought 3 seconds and I told him, I'm like, man, I could not do your roller coaster. He's like, I think he said he spent about 150 grand between the three. And so 50 grand a piece. He's like, on one of them, I lost everything, got completely wiped. On one of them, I made about 70,000. And on the last one, I lost about 10. Overall, I made about 10 grand. Not bad. And I'm like, yeah, but
not good. That's not good to me.
Yeah. And to me, I'm like, the roller coaster ride of losing everything on one, to me. Yeah.
That's not worth it for me for 10 grand. I mean, 10 grand is a lot of money, but for 150 grand, it's not.
Yeah. Yeah.
Yeah. That's something that I always, whenever I get into any investment, I need to be able to at least explain to my wife, because I have to know it enough to explain it, how I'm going to make money, how I'm not going to lose money, and how I would ever possibly lose the money. Like what's the way to actually lose the money? So that's always something I always have to understand myself, because if I don't understand it, I should not be investing in it. So that's why you try to learn as much as you can. Now, Chris, we could definitely keep going, but I know we are going to have our conference, the Real Estate Wealth Builders Conference, the multifamily commercial real estate investing and passive investing. And so we loved investing in all types of from real estate to passive investing, note investing. So it'd be great to see you there. And at the same time, how can people connect with you? Because most likely you're going to get some people that say, man, I really want to look into this and I want to learn how to invest in this way, especially if it only takes $5,000 to get into a note and getting 8% or more. I mean, that's terrific. But how can people find you? How can they reach out to you?
Yeah. So they can go to our website, 7einvestments.com. It's the number 7, the letter E, investments.com. You can reach out to me, email me, find me on LinkedIn. Thankfully, my last name is not very common. Spelled like the number 7 with an EY in it. That will be in the show notes as well. But typically most people just go to our website, and from there they can reach out to me, reach out to one of our investor relations specialists that we have, set up a call with them to learn more about the offering as well. And like I said, we try and keep things as simple as possible. All our investor relations people are out in California, so they're within the continental 48 states. It's not somebody calling you back at 1:00 in the morning like I had one time when I went to go invest with somebody, and it was somebody had on the other side of the world, and I'm like, oh man, check the area code and time zone before you call them.
Well, Chris, thank you so much for coming on, sharing us about this world of note investing and becoming the bank, which is, I mean, that's the way to make money when you really come down to it. But Chris, thank you so much for being on the show, man.
Yep. Thanks, Dustin. Take care.
And that is it for today. Go ahead and get my free real estate investing course. Text the word rental to 33777, RENTAL to 33777. You can also join my Real Estate Wealth Builders group coaching. Get all my courses. All right, guys, we'll see you in the next show. See ya.